stellar performance in the first half, as you describe it. Can you maintain that in the second, given the global economic uncertainties and the overall balance of risks?
Yeah, well, it's great. It's great to be here, and obviously, to your point, really stellar performance in the first half. Our EPS, and this is really where the accretive nature of the ARA transaction comes in. Our EPS was up over 30% year over year. We had AUM growth of 14% on a pro forma basis year over year to nearly $150 billion US. Fundraising, we raised nearly $4 billion of capital. We now have 12 of the top 20 global capital partners on the platform. But it's really the underlying fundamentals of our new economy business that are really the strongest we've ever seen. We essentially have no vacancy across South Korea, Australia, Japan, and even Southeast Asia. Really the first time we can think of where we almost have no space to lease from our warehousing side. So the backdrop is very, very strong. And while we are facing higher rates, sustained inflation, probably lasting longer than most imagine, inflation can also be a good thing for real estate. And we're seeing it. Really record rent growth across many of our markets. You take a look at Australia, I mean, rents may be up over 25% this year for logistics. So if you can capture that, and the benefit of Asia tends to be shorter term leases. So the ability to capture that rent growth can be quite a powerful trend. So we really obviously have to contend with a more challenging environment, certainly a geopolitical environment, but we feel good about the underlying fundamentals.
So you monetize these assets, as we know, through the REIT market, Jeffrey. So just give us a sense of how much headroom there is in yields moving to the end of the year and looking into 2023. If the fundamentals remain that strong and if there are no vacancies across the region in warehousing, it's a good problem to have.
You know, it is a good problem to have, and we certainly took advantage of it in the first half. We had a record $1.4 billion of divestments, primarily to ESR managed vehicles, including a nearly $1 billion portfolio in China, which we sold down during the lockdowns in Shanghai, which was a very important transaction. As we look forward, certainly there's a little bit of a bid-ask spread in terms of core real estate right now. You know, when you have elevated short-term rates and at the same time you have uncertainty about where long-term rates are going to settle, naturally there's no inducement for buyers to want to show up and compete, obviously, in this environment. And so you've seen most take a step back for the time being. Hopefully a couple good months of inflation prints, and then we'll start to get a little bit more visibility of where we think long-term rates may settle. With that, I think activity may even pick up further because especially for new economy real estate, the demand is strong. Capital partners, investors are under-allocated to these areas, and they're seeing the fundamentals. This is the type of real estate that is benefiting the most in an inflationary environment.